Hello, thank you for tuning in to KBRA Podcasts, a go-to source for topical briefings directly from our knowledgeable team members here at Kroll Bond Rating Agency. In this episode, we're covering a recent report you can find on kbra.com called Demand for Environmentally Friendly European Power Assets, Risks Weakening Credit Profiles. My name is Gordon Kerr, and I am the head of European research here at KBRA. And I am joined by my colleague Karim Nassif, the Director in Project Finance, Infrastructure and Corporate Ratings here at KBRA based in Dublin. In our report, we take a look at the project finance in Europe, where environmentally friendly or renewable projects are starting to become increasingly exposed to power market risk. This is been a result of the phasing out of renewable energy subsidies by European governments, lower pricing support provided by the contracts for difference as these auction prices have decreased, and generally speaking, a rise in the number of renewable energy projects. Factors that have really influenced the demand for project finance transaction, which further drives an increase in the exposure to the power markets, includes investors increasingly chasing ESG-focused assets with renewable energy style funding and a supplier demand for renewable energy projects in order to meet those demands from clients. As a result of all of this, we've seen financial innovation come to project finance to meet the need for higher yields from investors. And this has driven an increase in the exposure of these projects to the power markets. So, Karim, I'll now turn over to you and ask the question, how are you seeing these merchant-exposed transactions changing in the current environment?
Yeah, so as you pointed out, Gordon, it's really a confluence of these factors. On the one hand, it is, less subsidies, less direct support that is coming through. And also when we look, for example, at the CFD structure, the contracts for difference structure, we see that these are getting basically lower and lower and less meaningful for projects. We look at the price at which the CFD strike price is being set, and it's getting lower and lower. That is happening, as you say, in the context of investors wanting innovation, in ESG assets and needing to have, higher returns and higher yields. So one aspect, which is the regulatory and market aspect, is feeding into the other, which is the investor aspect. So as we see more merchant risk come to the market as a result, it does sort of beg the question for a lot of lenders and investors, what to do and how to get comfortable with this enhanced merchant risk. There are a number of investors and lenders who are basically uncomfortable because they see that it's very difficult to predict power prices out to 6 years or 10 years, or let alone to 20 or 25 in long-term projects. Many of them are, referring back to the days of, trying to predict toll road traffic figures, 10, 20 years ago, and how difficult that was to do and how many projects, experienced difficulty in that trying to predict such things. Others are, struggling to get committees to approve. Major banks that we've spoken to have struggled to get committees to approve deals that have more than, let's say, 30% or 50% of their exposure to the market. The reality is that the renewable targets are there for each of these national sovereigns within the EU. And there's going to be a need for the lending and investment community to find a way to get comfortable with these structures. And, what we're trying to tackle in the piece in some aspects is, how can the lending community, investment community, how might they get comfortable? And the answer in our view is really going back to the ABCs of project finance principles. It's getting comfortable with the rationale, the structure, and the financing. And with the rationale of the transaction, comfortable with the assets themselves, the technology in question, its performance, the ownership, who's behind the project, is there some equity, what's the leverage? And also from a financing perspective, the coverage ratios are solid and that there is some element of buffer against downside, because once you start to have to project something that is like power prices out to the future, it's very difficult to do that without having a really strong sense of how resilient the transaction is to downsides. And that may include, for example, break-even analysis. So for us, there is a way to get comfortable with the credit story in spite of the higher merchant risk, but it does mean some extra digging into, the basics of the transaction, the fundamentals, and as well, of course, a knowledge of the power price environment in that particular jurisdiction. What sets the power price and how those factors might evolve over time.
So that's how we are dealing with it from an analysis perspective. But how are the transactions adjusting and how are they changing in order to tackle the topic of these market risks coming into the transaction or increasing as a concern in the transaction?
I think we can sort of almost look at the transactions that are coming into the market in two buckets. Some of them are, in a sense, deliberately introducing risk, whether it's through a much longer debt tail after, let's say a period where contract revenues are backed by a corporate PPA. They might introduce a quite significant merchant tail period where the project is fully exposed, bullet structures as opposed to amortizing structures, less reserving, less liquidity. Those types of transactions are seeking, in a sense, to attract, I guess, an investment community that is happier with that increased risk. And we are seeing more of those transactions come to the market. The investors that are looking for investment grade are generally shying away from those transactions, but they are still finding a market for the reasons you mentioned earlier, Gordon, which is the drive towards, ESG mandate commitments by a number of investment managers, private equity firms, and so on. On the other scale, we see projects that are tackling the intermittency of renewables, the market risk that is becoming more and more inherent, and trying to find structures to get comfortable with an investment grade profile that can attract those kinds of asset managers that are looking for something a little bit more solid. And with those deals, what we see is a number of tools being used, higher coverage ratios coming to the fore, much more significantly higher than, traditional renewable projects that were done with, long-term feed-in tariff commitments. We are also seeing an ability to reserve and accrue cash in sinking funds to help protect the project against periods where suddenly there's a deterioration in the power price over, let's say, a 6 months or 12 months period during the debt service term, to support the transaction and to support the break-evens of the transaction over the life. Some deals we see also putting in place a mandatory requirement to accrue cash in periods where cash flows are strong and based on sort of regular updates from consultants that are, supporting the transaction by taking a view on the power price curve. So we see a number of tools being used to try and get the deal to meet investment grade or to come close to meet investment grade requirements by the lending investment community.
So this past week, we have COP26 in Glasgow, which has raised a number of headlines around ESG and the prospect for many initiatives going forward. In particular, ESG has shown signs of growing in the financial markets. But how are the developments on the ESG side likely to really influence this? You mentioned it just a second ago, but how are they likely to influence the market exposure to on renewable deals going forward?
Yeah, you're absolutely right, Gordon. I think what we do see is a very important impact on the power markets in general, and especially the new technologies as a result of some of the announcements that are coming out of COP26, but also the general energy transition drive towards net zero. There's some important commitments coming from the European Union, for example, with respect to some new technologies like hydrogen. What we see is essentially a way to try to marry the increasing amount of renewables that are going to come onto the grid with new technologies that can help support the predictability of the power supply through these various projects. And those new technologies that are being touted more and more are battery storage and hydrogen. And battery storage and hydrogen can be seen essentially as a means by which to allow for there to be a greater reliability of supply from renewable power projects. But also those projects will come initially with a requirement. I mean, the deals that will come to the market initially might more likely be hybrid transactions involving, solar, wind, and let's say battery storage. Over time, we might see, batteries, storage being financed independently. We might see hydrogen projects, carbon capture and sequestration projects, all being financed separately. And as these technologies start to be more and more supported through regulation, through targets, as part of the sort of the renewable mix plans that the EU would like to see and so on, investor focus will go towards what kind of regulatory and contractual support is there for these technologies, how proven is the technology in question, and how can we get comfortable over, let's say, 10, 15, 20 years to finance these deals on a project finance basis. So I think this is probably one of the next phase that we're going to be looking at, is how to take some of these new technologies that we know are going to be important going forward, and how to make them bankable, how to make them attractive in the same way that the traditional wind and solar deals that came to the market 10, 15, 20 years ago got that sort of extra support, regulatory and government subsidy support, how to get those new technologies essentially off the ground with the same types of tools and mechanisms.
Well, I can say that with the dramatic growth of green bond issuance, which operates on a use of proceeds basis, and both from sovereigns and from financial institutions, there is a growing wall of money that is prepared to invest into these types of projects. So I hope you're ready to be busy, Karim, because there's the prospect of plenty of those types of transactions coming through the pipeline as many of these countries target that net zero initiative. Thank you very much for listening. Thank you to Karim for your views, and for the full report, please go to kbra.com.
Thank you, Gordon.